Hi, I'm Eric Burkholder here with Jordan Bradford, Senior Advisor of Burkholder Wealth Management, and we're coming to you today to do another market update. So we'll kind of touch base on the quarter end, third quarter ended, and then a lot has happened in less than a month. So Jordan, why don't you just kick us off, kind of tell us what's happening?
Yeah, well, it's the market for the year has been reasonably good. However, here in the month of October, things have been a little bit more volatile, and it's been kind of choppy up and down for most of the year. So we've got some return numbers for everybody. So mostly, like I said, the overall market returns are decent, especially given kind of some of the what I would say maybe assumptions we're heading into 2023. But there's still plenty of things that people are worried about going on right now.
Yeah.
Specifically speaking here, just in the last couple of weeks or so, we've got war in Israel breaking out, which has definitely created some more volatility, and we're also seeing just in general maybe a little bit of a market kind of pullback because of that, or at least that's having an impact on maybe economic outlook here going forward for maybe the next 6 to 12 months, which is being priced into market returns.
Yeah, and I think something, since it feels very recent right now, is for people to keep in mind that how quickly markets move.
Right.
And even this year, which for us, just it feels like a normal year because the markets are like this almost every year. But people forget that the market started off very strong.
Mm-hmm.
Then we had kind of a decent sized pullback in the summer, and then we had a little bit of recovery, and now just in October, there's certain indexes that are off, 4-5% now. So,
right.
I think a good takeaway from all of this is, if you're trying to time those changes and your investment plan is based on you being successful in doing that, I would say that's very difficult to do. I mean, so now war's broken out in Israel, in Gaza, and that is probably affecting some of the market. Also, the interest rate uncertainty, but that all just immediately got priced into the market.
Right.
So, I mean, if you're in the market now, I would say it's probably too late, and we don't know if it's going to go down further or, the market, the bottom of the market tends to be when things are the worst, right? So, I think these are good learning experiences. If we can internalize kind of what's happening right now.
Right. Yeah. I think some numbers would help maybe do some of this justice.
Yeah.
So it's interesting. So October has definitely been a volatile month, but if you look at the actual return numbers, the third quarter was not a great quarter for the market. So the S&P was down about 3.3% in Q3. You have the Dow down about 2.1%, and the NASDAQ down about 3.9%. So, mediocre numbers across the board. Not a great quarter for the market in general. If you look at through the end of Q3, the S&P was up about 11.7% still, though. So that was even with that 3.3% pullback in the third quarter. That's pretty solid. That's a pretty solid return. If we finish the year with the S&P up 11.7%, we'd be just a little bit above the historical market average, which I think a lot of people would be really surprised by that, given just the volatile nature of the last 24 months have been.
Yeah.
But that's kind of gives you a little bit of a sense of just kind of how strange the market has felt this year, even though we're getting relatively normal market returns. It's just another one of those years where headlines are maybe grabbing most of the attention.
Right. Yeah, that's a great point. And we hound on this all the time. Is that while the average is maybe 10 for on a given year, no year looks like that. No quarter looks like that. No week. I mean, the ups and downs are much greater than that average. People, I think, well, if I get 10% here, we're gonna get the same, basically each quarter is going to be equal,
right,
or every week's going to be equal. Like it's not like that. And so the fact that we're within range of what would be a normal year,
right,
despite everything, it actually just shows you how resilient the market can be.
Yeah, and we're nearing the end of October, and even though we've seen a lot of volatility here in the last couple of weeks, the beginning of October was relatively strong. So we've wiped away a lot of that, in the last couple of weeks, but the S&P right now is still up about 11.5% year to date. So pretty similar to where it was at the end of the third quarter, even though we're seeing a lot of volatility here in the month of October. Obviously, there's a lot of time left here in the rest of the year. We still have nearly a full quarter left. And so we're going to see continued volatility in the markets, especially with, all the uncertainty of what's happening in the Middle East and obviously still what's going on in Ukraine. That does have an impact on market sentiment, and what we've seen it. As you mentioned, a lot of that's been priced in though. So, I wouldn't try to be timing the market and think, okay, now I'm going to get ahead and make trades based on what's happening in the news. But it's more so just, good educational material for us to all be aware that, that is having an impact on price fluctuation day to day, week to week, month to month right now. But I would say that there are still some good numbers in the economy, which is probably I would say maybe the reason why the markets are staying relatively solid for the year, even through what appears to have been, a bad year in terms of market news.
Right. Yeah. I mean, I think coming into 2023, there were many people, investment brokerage houses and economic experts. I mean, they were near guaranteeing a recession this year. So that has not yet happened. And again, just shows you the difficulty of predicting what's going to happen in the markets or the economy. And inflation has been trending down. We've had good employment numbers. Unemployment stayed at a good level. It hasn't risen. And so, you have all these silver linings. The economy is still, pretty resilient.
Yeah. Yeah, I mean, unemployment through the end of the third quarter was still at 3.8%. I mean, that's a really good number. I think the Fed would be very happy with that as a long-term projection. Inflation around 3.7%, still running a little high, but recent Fed notes have indicated that the Federal Reserve is pretty happy with what actions they've taken and how that may be impacting inflation in a positive way for the consumers. So we're still running a little higher than ideal. But it sounds like maybe the Fed's going to start maybe pushing a longer pause and see maybe what the impact of these rate changes are going to do, and if that's enough to potentially drop inflation back down to that 2 to 2.5 target.
Right. Yeah. And like we always talk about, at the end of the day, especially for our clients' portfolios that's in the market. Ultimately you're investing in companies. You're not investing in a stock price.
Right.
It's going up and down, and your ultimate success is based on trying to time that.
Right.
That if your house is priced on the market daily, it would swing wildly as well.
Yes.
Right. You wouldn't be moving in and out based on the price of that day. Right. You'd be looking at what is the underlying value of my home. The same with the market. At the end of the day, you are investing in companies across the world, all different kinds. They're making money in different tax environments and different government regulations.
Yeah.
And so that's the focus, and then having the right risk profile for the individual investor. Because we can't control what's happening in the Middle East or anywhere else, but you can control your portfolio, make sure it's supporting your goals. And so, we obviously are monitoring the market updates. That's why we do these, to give you guys an update on what's going on. But ultimately, you're investing for a long-term plan, and you're an owner in companies, a very small owner in a lot of companies.
Yeah, and something I like to think of, and this kind of helps me rationalize what's going on in the economy sometimes, is if you think about any big economic indicator, whether it's inflation running high or in this case unemployment is very low, but if unemployment were high, I would look at that and say, well, that's not a great thing for the overall economy, but all companies are basically playing by the same set of rules. And so if inflation is high, that's going to impact, every publicly traded company in one way, shape, or form. So to me, a high inflation number shouldn't say, okay, the economy is going to struggle, so I should move out of the market. Instead, it's just a different set of rules that the market is now playing by. And on the short term, you're going to see that fluctuation in price. But in the long run, that's what also helps build in long-term rates of return.
Right.
You can't get a long-term rate of return without accepting some of that short-term up and down.
Right.
And that's why, historically over long periods of time, the market's going to be closer to about a 10% rate of return. Is because, well, part of the reason that is the case is because in the short term you might have a year where, like in 2022, where the S&P 500 was down 21%, and then in 2023 here, right, the S&P's up about 11.5 so far. So you see those varying swings in market performance, and that's what ultimately drives that long-term rate of return.
Right.
If you're unwilling to accept the 2022s and the 2023s of the market, it's very difficult to get that long-term rate of return. Nearly impossible, really.
Right. Yeah. We all want it. We all want that rate. We want the high rate of return with no risk.
Right. You want 2023's S&P return, but you didn't want to have 2022's.
Right.
And if you got out of the market mid-2022 or at any point last year thinking, I'm going to wait for all of this to subside, you probably haven't put your money back into the market this year, because there's not been a whole lot of positive news that would lead me as an investor to think, okay, now's suddenly the time to buy. I believe that you just stay in the market and you always try to buy when you can.
Right.
Because I think that you're going to just have a better experience that way.
Yeah, absolutely. It's like working out. The stress and volatility of the market that's you working out on your investments, and if you can withstand that and you have a plan to get through it, you will get rewarded at the end.
Yeah,
it's part of that process.
Yeah, there's days where you feel really good at the gym, and there's days where you leave the gym thinking you just got hit by a truck. But ultimately, over the course of weeks and months and years, when you put in that hard work, you see results, and that's what's really important.
Yeah. Well, as always, if you guys have any questions about the current environment, market, economy, we're happy to answer them. And if not, we'll see you on the next video.
Thanks for tuning in.